David R. Guttery is the president of Keystone Financial Group in Trussville, Alabama. David Guttery and Brandon Guttery are financial advisors and represent Emeritus Investment Company, LLC. Please stay tuned through the end of the video for additional important disclosure information.
Hello, everyone. Our sixth podcast of this continuing series will be brief since we also published our monthly video just a few days ago. I do want to use today's podcast, however, to reaffirm and update the trends that we continue to see evolving and observations of what forward indicators may be suggesting. Again, please feel free to share the link to this podcast with anyone that you may feel would benefit from having the information that we are disseminating through this channel. So as usual, let's get started with a current market overview. Now, this was current as of the close of business on Wednesday, the 20th of May. The Dow Jones Industrial Average closed up by 369 points with a value of 24,579. Again, remember that the intraday low for the Dow Jones Industrial Average occurred on the 23rd of March with a value of 18,213 points. Only time will tell if this proves to be the market low for the event. Conversely, the previous market high was established on the 10th of February with a value of 29,379 points. So, from the February high watermark to the most recent intraday low on the 23rd of March, the Dow Jones Industrial Average was down by about 38%. Now, you see this graphic that illustrates that since that low point, as of the time of this recording on the 21st of May, the market is higher by 6,363 points for a gain of 34.94% from the March intraday low. I'm a visual person, and this graphic helps to put the last 6 months into visual context. While that might help to visualize the degree by which we have embarked upon a potential recovery, it also affirms the angst that all investors still have. We all want this to be over and quickly. I believe that we have the potential for much better days ahead of us, and we'll talk more about that in a second. Nonetheless, patience remains the key. And you can expect that any recovery will also include periods of second guessing and retracing. This is a normal characteristic of any recovery from an acute shock. All right, so economic overview. We mentioned a lot of this in our video. We're going to cover it again here in the podcast. Again, I'm reminded of a quote from Winston Churchill, paraphrasing, "This isn't the beginning of the end, but it may well be the end of the beginning." We are not out of the woods, but I do believe that we have a much more clear path to recovery than we had just 3 months ago. So let's continue our observation of what 3 historically reliable forward indicators are telling us about what might be on the horizon over the coming 6 to 12 months from an economic standpoint. Well, we just talked about one. The market is a forward-looking discounting mechanism. And the fact that we are almost up 35% from the intraday low tells you that it is pricing into itself and discounting the likelihood of seeing a more robust economic outcome. So what are some others? Oil. Take a look at the energy market. You see on this graphic, this is the most current snapshot from the CME group. And as I've mentioned in other podcasts, I routinely monitor this website and observe the forward oil futures contract prices. This is a referendum on what the hedgers, the consumers of oil and distillates, think about the future price of energy as well as the opinion of speculators. Over the coming 12 months, we can see that the energy market believes, as a function of future prices, that an economic resurgence is likely. If the anticipation for energy demand wasn't perceived to be stronger over the coming 12 months, then you wouldn't likely see oil trading at these levels. It would be difficult, if not impossible, to have an increase in demand without a resurgent economy being the catalyst for that demand. So another good forward indicator. Now you see the graphic for the most recent Snapshot of the TED spread from the St. Louis Federal Reserve Bank. And in last week's podcast, I explained how the TED spread was a good referendum on forward economic views from the bond market. The TED spread is simply the difference between the 3-month Treasury bill and the 3-month LIBOR based in U.S. dollars. So again, I'm going to expound on that for just a moment. If we are in a solid period of economic activity, then it is likely that debt investors will favor higher yielding corporate issues over the safety of treasuries. Remember, there's an inverse relationship between price and yield. As prices rise, yields fall. So as demand for corporates rise and prices rise, yields on corporates fall. And the prices of treasuries decline as fear subsides and yields rise on treasuries. As a result, the spread between yields will tighten. Conversely, if we have the perception of weak economic conditions ahead, you will see the opposite. Credit spreads will widen. Look at where we are. Clearly, the TED spread spiked at 142 basis points on the 27th of March. But as of the 21st of May, 7 weeks later, the spread stands at 29 basis points. As you can see on the graphic, this is in line with the spread that we normally see on average. The spread is clearly tightening from the March 27th peak, and frankly, I've never seen the TED spread tighten by 113 basis points or 79% in just a 7-week period of time. This is a good, positive, forward indicator signal of what the debt market believes to be in store for the U.S. economy. Now, many of you have asked about why I believe that this crisis will not devolve into the kind of financial crisis that we experienced in 2008. And I've offered a few observations on that point, but for now, let me again reference the TED spread. So now this graphic that you're seeing goes back to January of 2007. On the 15th of October in 2008, the TED spread spiked at 441 basis points. During this time, bank lending functions had all but ceased to exist. Compare that spike to what we see today at the far right of the graphic. This suggests that the bond market clearly doesn't anticipate a repeat of the 2008 financial crisis. Furthermore, the environment is just completely different. First, in 2008, companies were highly levered and had very little cash. Since then, through 8 years' worth of 3 rounds of quantitative easing and a decade's worth of multiple reasons to hoard cash, today, I can use the Morningstar workstation to screen for debt leverage ratios. I see hundreds of companies with fractional debt leverage. And as of the January edition of the Harvard Business Review, companies haven't had more nominal cash on their balance sheet since 2011. As for mortgage defaults, with the dramatic improvement that we've seen in the 4-week moving jobless claims average, suggesting that an increasingly greater number of employees that were once laid off and are now furloughed instead, and with weekly unemployment benefits being $827 a week over $227 and over a 4-month period of time rather than a 2-month period of time, and with the 4-month forbearance provision for mortgages serviced by GSEs under the CARES Act, no, I can't make a solid case for why we should see a massive wave of mortgage defaults. This reminds me of what happens in Alabama whenever the word snow is mentioned in the forecast. Everyone immediately remembers the great forecast error of 2014 and they panic as they prepare for the next ice age. Look, each economic crisis is different, and so is this one. And so far, I see no evidence of a multifaceted financial calamity over which we should be worried. So let's talk about the disease, COVID-19. We are observing trends across the globe. The graphic that you see right now is from Worldometers, and it reflects the daily new cases in Sweden. I'm observing this country because they never shut their economy down, as did virtually every other nation, and we can clearly discern the bell curve pattern Now you're looking at a graphic, again from Worldometers, that depicts the United States and our bell curve as it pertains to daily new cases. And clearly, we seem to be following the same pattern as Sweden and honestly, most every other country. Now you're looking at a graphic from the New York Times talking about states that are open. This is good news. 47 states are now reopened either fully or regionally. 3 states remain officially closed but are projected to open at phase 1 levels within the next 2 weeks. This is important because the reopening needs to be a simultaneous lift across all economic sectors. It does a car manufacturer in Michigan no good to reopen if suppliers in another state are not reopened and providing them with parts for the car. Frankly, we're ahead of where I had hoped that we would be by this point in the reopening process. So other countries in reopening, again, the real question remains, is it possible for us to safely reopen the economy without invoking a second wave of COVID-19? And that is a risk that Fed Chairman Powell addressed in his remarks last week. Well, let's take a look at what we see in other countries across the globe. We've talked about the Market Flash PMI index within other podcasts. It simply quantifies output. You're either making widgets or you're not. This isn't a number that China or any other nation can manipulate. Every country has a PMI manufacturing index. Any reading below 50 indicates contraction. On the 28th of February, the China PMI was 35.7. That is depression level. 1 month later, on the 31st of March, it stood at 52. That in and of itself was impressive. I've never seen a PMI index jump that quickly in 1 month. So there's no way it could have without factories being full of healthy workers. Still, it is but one data point. On the 30th of April, we observed a reading of 49.4. This is a backward-looking indicator, meaning that factories had to be full of workers and healthy workers, and for at least the last 60 days for manufacturing output to resurge to this degree. Now you're looking at a graphic of active cases in China. There is a lot of conjecture over what you can believe out of China. This is actually a composite from 5 different World Health organizations through Worldometers. It's the best we have, folks. But going back and looking at the 60 days where we saw a resurgence in manufacturing activity, we do not see a corresponding new wave of COVID-19 in the epicenter country. Now, only time will tell if this trend sustains. Between the 31st of May and the 2nd of June, we will observe PMI readings in 33 nations across the Asian and Eurozones. It will be interesting to see if we observe similar patterns of manufacturing recovery and without evidence of a second wave of COVID-19. As these reports come in, key reports, we're going to receive on the 1st of June, we'll get them from Japan, South Korea, China, Poland, Spain, the Czech Republic, Italy, France, Germany, the United Kingdom, the United States, Canada, and the Eurozone composite. So we should know more on the 1st of June about the status of the U.S. economy when we have our next PMI reading. I'll be keeping a really close eye on what we see developing across the Eurozone over the coming weeks for insight into what trends that we may see developing here over the summer. Remember, markets are discounting mechanisms. We are up almost 35% from the March intraday low. Along the way in the recovery, you have to expect that the possibility of a second wave of COVID-19 would be considered, and the potential for a weaker economic recovery that might result, if, could, might, and possibly do not translate into a referendum of certainty. Sure, a worse than expected recovery might materialize, but what if it doesn't? What is the energy market telling you? What is the bond market telling you? What can we observe in other industrially developed countries across the globe? You have to look more deeply than the sensationalized headline for those answers. And it is this kind of data that you've got to have in order to navigate through periods of time like this. So what about employment? Look, several weeks ago, I suggested that claims for unemployment benefits would likely decline, and sharply, as the impact of the CARES Act was felt at the employer and the employee level. This morning, we learned that weekly jobless claims were 2.438 million, Each week, for 7 straight weeks, that number continues to decline, and today's number is 64.3% lower than the worst report of 6.83 million claims 8 weeks ago. Now you're looking at a graphic of the 4-week moving jobless claims average. From the 18th of April, when the 4-week moving average stood at 5.79 million, to today's reading of 3,042,000 claims, the 4-week moving average has declined by 2.748 million claims, or 47.467%, according to the St. Louis Federal Reserve Bank. So yes, I believe that the significant improvement in the employment metrics corresponds to the passage of the CARES Act and the impact of both tranches of PPP funding. This is a quantifiable way to argue that indeed it is more likely than not to expect a robust resurgence of economic activity. So in conclusion, you're seeing this bridge graphic, and we've used this now for all of our podcasts, and I use it to illustrate the ability of the provisions in the CARES Act to span this economic closure event and maintain the purchasing momentum of individuals. From the record strength that we observed in February to now, on the other side of this chasm. Earlier, we talked about how tight credit spreads were and that was indicative of what the bond market perceived about current and future economic conditions. Go back and look at that chart and notice how tight those credit spreads were just before the efforts to flatten the curve before COVID-19. We have to preserve that strength and momentum, and at this point, I see no reason to doubt that being the most likely outcome. Still, over the coming days and weeks, you are going to hear conjecture over a double-dip recession or a double U-shaped recovery or a longer than projected economic contraction and less than robust economic recovery. The market will ebb and flow on this. It's natural. It happens. Expect it. Right now, from what we can quantify, it does not appear to be the most likely potential outcome. So look, stay focused on where we're going. As we've discussed before, you cannot react to a shocked market. If you try to do so, it historically creates a larger problem of having to battle the emotional aspects of when to return to the market. If your objectives remain in the intermediate to distant future, make this crisis work for you. This shocked market, at least so far, is following the same pattern as 15 of the last 16 recoveries from acute shocks. Patience is the key, and a focus on where we're going, not where we are, is of greatest importance. Thank you for your attention. We'll have another podcast for you next week. Have a great weekend.
David Guttery and Brandon Guttery offer products and services using the following business names: Ameritas Investment Company, LLC, AIC, member FINRA, SIPC for securities and investments. Ameritas Advisory Services, AAS, for investment advisory services. AIC and AAS are not affiliated with Keystone Financial Group. Products and services are limited to residents of states where the representatives are registered. This is not an offer of securities in any jurisdiction, nor is it specifically directed to a resident of any jurisdiction. As with any security, request a prospectus from your representative. Read it carefully before you invest or send money. A representative will contact you to provide requested information. Representatives of AIC and AAS do not provide tax or legal advice. Please consult your tax advisor or attorney regarding your specific situation.